falls as sales soften up. But no matter how you look at it, running Doge along with these three huge companies that he runs, it's just another big responsibility and something that pulls him away from this business that investors aren't completely sold on at the moment.
David, thanks so much for joining us. David Welch is our Detroit bureau chief, talking to us about Tesla. Still with us is Moneta chief global market strategist Ethan Devitt. Ethan, what's your take on this trade war and how it turns out? I mean, do you trade it, or do you set your chips and then leave them on the table?
Well, great question. I mean, this new regulatory oversight and new rules coming whether from China or Canada, just another example of the quiver of uncertainty that is facing investors today. It is impossible to predict. The one thing we know about regulatory backdrops is that they have to be in some way to have some clarity to them and some predictability in order for investors to trade them. We can see that there is absolutely none of that today, and the same goes for the tariff regime. So I would say what we do is we try to have that global portfolio, because we know that globally, not every company is going to be similarly affected by the tariffs. In fact, the non-US multinationals are probably somewhat insulated from that. It's the US multinationals that might have the most to fear. And that, again, this is, again, justification for having a well-balanced portfolio. So there is absolutely no predictability. And I think that is why the consumer sentiment is as low as it is, and why executive C-suite sentiment is as low as it is. It is difficult to predict CapEx and very difficult to look to the future with this uncertainty hanging over. Even
with that uncertainty, stocks aren't that far below the highs. And Bank of America also put out that their customers saw the biggest inflow. They put the most money into equities last week of 2025 by a wide margin. Is there a risk that come for April 2nd, that we are asymmetric going into it, that the bigger risk is to the downside, considering that equities have, for the most part, held up despite the sentiment?
It's interesting. The April 2nd date, I've heard that discussed as being perhaps positive news that's on the horizon there, and that's perhaps what markets are sensing at the moment, and why they're behaving a little bit more resiliently than we would have expected. There is a juxtaposition between the retail investor and the institutional investor. The institutional investor seems to be rebalancing, pulling money out of US stocks and going back into the non-US holdings that have been unloved for some time. We also know the other factors at work is the large amount of money in money market funds that are sitting there earning decent money, but looking for that risk trade. We know inflation is still stalking out there, and that money market fund and their return will not do that well in a higher inflationary environment. We don't think that beast has been slayed yet. So I would say it's that risk-seeking behavior, the FOMO, and just the news flow around AI. It's very hard to resist for retail investors. We still have meme stocks that are performing well. We still have the discussion around AI spending. So I would say that's what Barclays is picking up in terms of the flows. And I would actually be looking more for an upside surprise on April 2nd than a downside surprise at this stage. We were wondering whether the Trump put was alive and well, and it seems from the last few days that there may be life in that thing yet.
I want to ask you about financials, not least because Jefferies is out with earnings after the bell, and we're going to preview that later on. But if you look at the KBW Bank Index, it's taken a big hit, to be fair, but it's up again today, and it continues, I think, a 9-day winning streak, maybe its longest winning streak ever. Yet to catch up to levels that we saw at the beginning of the year. But what's your take on financials?
Well, financials were expected to have this great tailwind of less regulatory oversight from the new Trump administration. That took a little bit to kind of play out, and we certainly don't know yet the state of the regulation that's on the cards there. But I would say that given we've seen trading volume been much higher, M&A has been generally robust. We haven't seen the IPO climate pick up, although we do have a sense that that's CoreWeave, et cetera, that's likely to be at least some life in the IPO market. So I would say that actually stacks up quite well for financials. They are perceived as defensive stocks that will do well in a rotation into defensive stocks and away from higher tech. And equally in Europe, unloved for so long, and financials have been doing reasonably well there with the expectation of a bit more economic growth and a resurgence of spending. So I would say I would be quite optimistic around financials at this stage. We haven't even seen the regulatory change come.
Maybe the animal spirits are coming back, up 10% over the past 9 days. Ethan, thanks so much for joining us. That's Moneda's Ethan Devitt. Now, financials are one of the sectors on the move. Let's take a look at some other stocks on the move. Joining us now is Bloomberg's Denitsa Sakova. And you're looking at GameStop earnings, but maybe that's not what's moving the stock this morning.
Yeah, actually, the earnings report is pretty bad. We're seeing a 28% drop. We're actually seeing the stock up 14% today. This is the biggest jump since December. And it's something we've watched other companies do. It's allowing Bitcoin to be part of their treasury reserve, which is obviously a method that's been popularized by Michael Saylor. We saw Strategy, formerly known as MicroStrategy, jump more than 2,000% since 2020 after they started buying Bitcoin and using it as a inflation hedge. Now GameStop is suggesting to do the same, and there is a lot of optimism based on that. Even though we got a pretty bad earnings report, the stock is up and is having clearly a lot of retail supporters being excited about it once again.
The stock on Chewy, I think, at least was down in the pre-market. If we pull it up, we'll see. Wow, it's bounced higher. That's awesome. So Ryan Cohen, there's a connection here, right? Ryan Cohen, who's the CEO of GameStop, I think also owns a substantial stake in Chewy. What's the story with their earnings?
Yeah, for sure. Something we've seen is that this is obviously one retail sentiment name, but what we're seeing here is actually very good news from their earnings. The company has reported fourth quarter sales that beat estimates, and what we heard from the CEO is actually this is well above their high end of estimates. So this is a really good earnings report. We hear Piper Sandler and Bloomberg Intelligence analysts are very bullish on the company, saying that there is a lot of demand for those supplies. One thing they do is they've really grown their customers, and they also have a auto delivery service that's been very popular, and that's really helping the stock. The stock is not up a lot this year, but last year it had a 40% jump. So clearly there has been a lot of interest in this company.
All right, Denitsa, thanks so much for joining us. Denitsa Sakova talking us through some of the stocks that are moving just after the open. Coming up, we're going to talk about more. Copper miner Freeport-McMoRan jumping after President Trump signals that tariffs on the metal are coming sooner rather than later. That would help them raise the price for their product. This is Bloomberg. You're watching Open Interest.
Let's get you some top calls this morning. Some of the analyst action in focus. First up, Trade Desk getting an upgrade to a buy at CRA. The analyst says that the valuation is very enticing and sees the ad tech company benefiting from growth drivers. Next up, we got Summit Therapeutics for you. Those shares up 0.5%. Upgraded to a buy from Citi thanks to optimism on the biotech's cancer drug. The analyst over there saying that the drug could be a, quote, paradigm shift. Finally, we got CarMax for you. That being upgraded to a buy at Stephens. Those shares up 2.33%. The analyst over there saying that there's an attractive valuation and believes that CarMax will marginally benefit from most tariff scenarios, at least in 1 year. So rare company, Matt, that can do a little bit better off the back of some more car tariffs.
Yeah, absolutely. Let's talk about tariffs a little bit more. Copper is higher, including copper miner Freeport-McMoRan, after a Bloomberg scoop that U.S. tariffs on copper imports could be coming within weeks rather than months, as had been anticipated. Last month, President Trump directed the Commerce Department to open an investigation into the potential of copper tariffs. Trump appeared on Newsmax yesterday to talk about the tariffs poised to take effect next Wednesday.
Not too many. Not too many exceptions. No, I don't want to have too many exceptions. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people.
Here now with more on the impact of copper tariffs is James Atwood, Bloomberg's senior commodities reporter in Santiago. And James, of course, you're there because so much of copper is mined in that region. What is it going to look like getting that metal here in the U.S. where companies need to buy it and work with it?
Well, we've seen that the prospect of tariffs in the U.S. has spurred a record amount of copper being directed or shipped to the U.S. from Latin America, places like Chile and Peru, but also being redirected from other parts of the world and stocks taken out of warehouses elsewhere, draining stocks basically to get that metal to the U.S. Ahead of the tariffs. That's part of the reason why there's a very large difference between New York copper prices and the LME prices, which is a lucrative prospect for traders. Now, if those if the tariffs come in sooner than people thought, as you mentioned, the Section 232 investigation, if that takes a lot less than people thought, all that copper on the water or the copper being prepared to be shipped to the US may, or some of it may miss the boat. Certainly the window may close before people thought.
I'm so obsessed with this, James, because it's not just copper, it's gold. It feels like there are commodities just being flooded into the U.S. on planes, on ships, everywhere that they can find them. So they're trying to bring copper into the U.S. Are there companies here like the Freeport-McMoRans of the world that benefit from this, that already have a presence in the U.S. and will do better off the back of it?
Yeah, Freeport is probably the most obvious case. It produces both from its mines, and it has a copper smelter. Also, Rio Tinto has mining operations and a smelter, and there are other companies as well. There are also some projects apart from the tariffs on copper. There's also measures underway to incentivize mining projects to boost local production. So anyone who has assets in the US now, either operating or idled, stand to benefit.
James, thank you so much. Bloomberg's James Atwood, senior commodities reporter for Bloomberg News. You know, Matt, one time I asked to see the gold under the Bank of England, and they told me I couldn't go because if I had seen it, I would become a kidnap target, because someone would know that I know where it is and kidnap me to take them to it.
Everyone knows where it is.
I know, but I guess how to get there, I'm not certain. That was the excuse they gave.
I love the idea that there's gold under the Federal Reserve Building in downtown New York, and that underground vault is right next to the underground trading pits of the New York Stock Exchange. So I've always thought it'd be cool if somebody wrote a movie script about down on their luck traders who tunnel into the Federal Reserve and steal the gold.
Well, we need to make sure it's there, right?
Yeah, absolutely. So our gold is in Kentucky, though. Our gold is in Fort Knox, right? The central, the central bank holds gold from other countries here in New York.
But again, it's flooding in, it's going there. We need to take a look. We need to audit it. we need to make sure it's there.
I'm all for it. All for the conspiracy theories.
Everyone, invite Matt and us to your gold storage facilities. Are coming up on the show. Elliott sues Phillips 66 in an attempt to boost board turnover. We're going to talk about the activist strategy next on Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing. Just about 23 minutes into the session, you can see the major indexes are down. The S&P 500 off by almost 0.2%. The NASDAQ falling further because of the drop in NVIDIA. Come over here with me to look at that big heavyweight stock. Off right now 3.3%. It's worth 8% of the NASDAQ index. Tesla's down as well, 2%. You can see Apple's a gainer, so that helps lift the S&P a little bit, as it is the world's largest company and the biggest weighting on both the S&P and the NASDAQ. I think it's very interesting that Chewy now is down 0.4%. It was off pre-market, came out with earnings. It was up in the live trade for a few minutes. Now it's fallen down again, Danny.
Some crazy volatility. And by the way, Jess Metten writing a great story for Bloomberg. That liquidity has been sapped from this market, maybe why we're seeing so much up and down. Well, let's get you the latest activist investor push. Elliott has filed a lawsuit against Phillips 66, seeking to boost the number of board seats up for election this year. Bloomberg's Crystal C reported on this, bringing us this story, Crystal. So what exactly is Elliott's aim in this?
So Elliott has been pushing for changes at Phillips 66 since last year, or 2023, really. They have shown him the stock, and they're telling the company that you can do better. It's always that, their stock is undervalued, you can monetize certain assets, and this is we're getting into the activism season where corporate elections are getting more serious, and the latest news is that Elliott wanted to make sure that Phillips 66 is running for a director nominee this year, and the company this morning have announced their four. So from here on, we're just going to see if the two can come to some sort of resolution, or if does that really go to a full-on election.
You have been all over this activist movement, right? Not only the Elliott lawsuit and Phillips 66, but also Engine Capital potentially pushing for a strategic review of Lyft. And there are other stories, I think, around Autodesk, which makes the software that architects use. So what are the other stories you're focused on?
Yeah, like I said, it's activism season. Everything is getting more serious. This is really the moment where people are deciding whether they want to get aggressive and push ahead with electing their own directors, hoping that they could effectuate change within companies. And Autodesk is a good one. So Starboard actually named their three nominees this morning to Autodesk. Like you said, it's a software company that serves software architects. The story here is that
AutoCAD, for example, is one of the programs they make that architects all use.
So the story here is that Starboard has been there for a while, and they've been talking to nominate, and they think the company, after having their accounting prop, could do better, could probably see better board and better management teams. And the same with Lyft. The same thesis is that Engine Capital thinks that they could use new board members and perhaps do a strategic review, which would be very interesting given Lyft was such a tech darling not so long ago.
All right, Crystal, thanks very much. Crystal C there talking about all of the activist stories that she's covering for us here at Bloomberg. Take a look at the S&P taking another leg lower, now down 0.25%, and it is really these communication services companies that are moving lower. They were the ones that were gaining yesterday. Today they're down. Amazon is down. Facebook is down. Google is down. Microsoft is down. Netflix is down, adding to the drop that we see from NVIDIA and Tesla. Coming up in the next hour, Nancy Tangler joins us, the CEO of Laffer Tangler and the CEO of International Paper as well. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. Sonali Basak and Katie Greifeld are on assignment. Coming up, 3 days in the green meets its end. Anxiety brews ahead of tariff deadlines. And as markets await more clarity on Trump's tariff plans, the CEO of International Paper tells us how he's navigating the uncertainty. Plus, big bonuses, Wall Street payouts surged last year to nearly $48 billion as industry profits also soared. Now, the Congressional Budget Office releases its estimate for U.S. debt limit deadline today, this morning, and any moment. Bloomberg's chief international economics and policy correspondent Michael McKee joins us now. Mike, again, I'm not sure if that data is out at this moment, but what are we expecting, or do you have it in hand?
It hasn't come out yet. We're just waiting at this point for the government to release the data on the internet. But what they're going to be telling us is when they think the X date is, when the government can no longer pay its bills and the United States would essentially be ready to default. So that is a key date for people on Wall Street. It's not necessarily the date that they will default, because everybody's trying to guess at what that is based on spending patterns and tax collection. But it could be an issue for people who are trading, especially in the money markets.
Yeah, we'll see what that date brings us. Hopefully we will get that data soon. Thank you for the setup, Mike. That is Bloomberg's Mike McKee in Dallas. Some other reports seem to suggest that would look like something like the summertime. Okay, let's get a look at some stocks that are moving in this hour. Joining us now is Bloomberg's Nora Melinda. Nora, kicking it off with some copper this morning.
Yes, I want to look at Freeport-McMoRan. This was a company I wasn't familiar with, but this is after a Bloomberg News report that Trump suggested that tariffs on industrial metal could be coming in weeks rather than months. And we did see shares of this company actually higher at the beginning, but we are seeing them trailing into the red now. But this is a really interesting topic, especially as we're thinking about this April 2nd deadline.
I have to say, I will never forget when I was a cub reporter like 25 years ago, and I realized it wasn't McMoran. It's McMoRan, and that makes it so much more fun to say,
I had to
right?
look it up. I said McMoRan.
Yeah. There's another company that I hadn't heard of, although it's worth substantially less, moving today, Humacyte.
And it's not surprising that you haven't heard of it. It's actually a quite small biotech company.
Penny stock is what we would say.
$2.6 million in market cap, so pretty small here. But it is making a big move here. We're seeing shares down more than 30% in trading today. And this is after it offered 25 million shares at a 30% discount. That's not a good look for a company when we're thinking about investors that are looking for great returns. They actually have shares that are offered via TD Cowen, Barclays, BTIG, and Benchmark among some of those names.
Yeah, I mean, it's going to be moving 30% on a move of like 70 cents. So that's what a penny stock will do.
Okay, it's $264 million.
But it's literally moving 70 cents.
Okay.
Still an important story, Nora. Thank you for bringing that to us and the others. That is Bloomberg's Nora Melinda. Okay, now we have the numbers coming out from the CBO. Again, it is its estimate for the U.S. debt limit deadline. Let's bring back in our chief international economics and policy correspondent, Michael McKee. Mike, I think we have the timing this time down pat. What does the data show us?
Well, what they're saying is we could reach the debt ceiling limit in August or September. August would be the earliest date, September the latest, and it all depends on how much comes in tax revenue and how much the government spends between now and then. One interesting note is that the IRS has been cut back in terms of personnel by the DOGE effort, and some IRS experts are saying that will lead to lower tax collections, which could push up the date. The CBO is not weighing in on that, but it is something to keep an eye on. Right now, Treasury is spending down its general account at the Fed, savings account, as you will, that the Treasury put together. It was over $800 billion. It's now down to $364 billion. So there is only a little bit of headroom left. It does give them some time to work out the debt ceiling and see if they can get it through Congress.
Lower tax collections probably isn't the main concern for most Americans, is it, Mike?
Well, it's not the concern for most Americans.
It's the refunds. It's the refunds. Right? How long are they going to take to get out?
Well, they may take longer, but what they're talking about is especially higher income people may be paying less than they should, and we won't collect as much money. That's going to be an issue if the debt ceiling isn't resolved fairly quickly. That's going to be part of this reconciliation bill, and right now the House and Senate are far apart on that.
Mike, thanks very much. Michael McKee there in Dallas talking to us about the X date for the debt ceiling. Let's get a quick check on NVIDIA right now. That stock has been a real drag on the indexes, and it continues to move lower, now falling $4.65. So in terms of the S&P, NVIDIA is the biggest drag. It's taking off about 10 points, 13 actually, from the S&P 500. You've also got Tesla falling, Amazon off, Meta down, Microsoft, Broadcom, Google, and the list goes on in terms of the Mag 7 weights. I can't see any of them as gainers today. Let's talk about this with Nancy Tengler, Laffer Tengler, CIO and CEO. What do you think about these big megatech companies right now, Nancy? I mean, they boosted the market 50% over the last 2 years and have been a huge drag in 2025.
Well, Matt, I think you have to play the long game with the technology and the Mag 7 names, and we think the long game is still intact. But the bears don't get to be in charge very often, so they keep taking runs at these names. You know, we just saw a nice rally last week and earlier this week, and then now we're getting pressure again. And so I think as a long-term investor, you want to step back and you pick your spots. And there's a couple of the names we've been adding to, but generally speaking, we had been diversifying out the portfolio. We've added some energy names recently, some pipeline names, and we think you just continue to do that. These are still great companies. This is, in the sense that I've drawn the analogy to the 1990s, in one way, this is not the 1990s. These companies have robust balance sheets. The technology, and by that I mean AI and AGI, are much more compelling than eyeballs and clicks, which is what we had in the 90s. And so I think you have to believe the worst of what you're hearing, and that is that, we're not going to build any more data centers, that, DeepSeek is going to take over the world, in order to say, I don't want to own any of these names. And so we've been adding to them selectively, but don't be in any hurry.
Nancy, I love a version of you that's buying NVIDIA, because there were so many days where we talked last year that you were holding out because of just how expensive it is, how much it had run. But looking at NVIDIA's PE multiples at the moment, it's basically in line with where we were December. You had a big run up and then a fall, and then you start to come back. So why are you still comfortable adding on NVIDIA, despite the fact, again, save for the little blip that we've been getting, it's basically where we were before we entered the year?
Yeah, good morning, Danny. You and Manus bullied me into buying it. Every time I'd go in, you'd ask me. No, what we saw in the summer was a company that is generating still, even though decelerating, very strong earnings growth, and at a price earnings to growth ratio level, it is very cheap. And so what you have to ask yourself is, can it continue? Will it continue, even with slower growth? And we saw this with Microsoft and the cloud business. At one point it was growing over 90%, and now we're at 30. I don't know. I can't feel too tragic about that. So you pick, again, you pick the opportunities, you add to it. We bought some 2 weeks ago, just added to NVIDIA a little bit. We added to Tesla. We added to Palantir. We added to names that really got hammered on the expectation that what we believe about the build out will continue, and that we are pretty much still in early innings.
I saw a chart this morning. 3273 is the number for those of you with the Bloomberg chart library at your fingertips. Just type G #BTV 3273. It shows that Tesla buyers are much more likely to pile in when the stock's going up. That's not the case with NVIDIA buyers. And you've seen that. Here's the chart. Thank you very much, Joe. So glad you're back. What do you think about Tesla here? I mean, it's lost half of its market cap, and yet retail investors are still piling into this stock. Nancy, is a car maker really worth $700, $800 billion?
No, it isn't, Matt, but an AI company and an energy storage company and a full self-driving company probably is. And so this has always been a narrative stock, and it has been driven by retail investors, which is why you don't see the follow-through in NVIDIA, because it's more owned by institutional investors. But just think about this. Tesla's up over 15,000% since the IPO in June of 2001, I think, 2000. And the stock has been in a bear market almost 50% of that time. So you've earned an annualized return of 40+%, but you've been in a bear market. So the time to buy this stock is when everyone hates it. We reinitiated when Musk was selling his shares to buy X, then Twitter, and then we've used strength to trim back the holdings. The reason this stock is not in our 12 best ideas or our 5 for 25 is because of the volatility, but you do want to own it for the long term. So if we bought in a couple weeks ago at 240, 225, am I going to be happy 2 to 3 years from now? Yeah, I think so.
Yeah, buy when others are fearful. I think it goes, Nancy.
I remember when I actually remember the IPO in 2010 because I had driven a
2010.
Roadster.
Thank you.
I drove a Roadster with Jason Harper, and I thought it was so cool.
Do you wish that Bloomberg would allow you to buy the stock? Is that a?
That's exactly what I was going to say. Like, I so wanted to buy this stock, and everyone said, they'll never survive. In a world where General Motors and Ford exist, they're going to be stepped on right away if they do well.
But you probably would have been fired, and what a loss that would have been for all of us. So I'm glad that your finances don't reflect you buying Tesla. Nancy, luckily you don't have that issue to deal with, but I do wonder on Tesla. Dan Ives of Wedbush, who is a Tesla bull, to be very clear, and is still long-term likes the stock, he has been arguing that he will have to downgrade Tesla if you don't see a more even balance between Musk's efforts on Doge and Tesla. Not to say that he needs to step away from the government completely, but just at the moment, it's too uneven. How much are you paying attention to Elon Musk's politics, and could that sway you on just how bullish you are on Tesla?
100%, Danny. So, but here's the rub. So remember when he was sleeping on the factory floor and he was on the Joe Rogan podcast?
Production hell.
Yeah, and I just said, man, there were no earnings. This is gambling with our clients' money. We got out and it went up fourfold. Now we had a double in the stock, so call it a Pyrrhic victory. But I think of course it matters. Leadership matters. He showed up last week. The stock rallied. I think on that news, you never really know, but he must be present. And if you read his biography by Walter Isaacson, you will see the value of him being engaged in the company. So I'm not minimizing that. But I do think it creates an opportunity if, in fact, the stock does get downgraded by Dan, who's a good friend. But I'm not going to sell on that news necessarily. I might actually buy more.
Wall Street's best dressed as well. Don't forget. Nancy, great to have you on the program. As usual, Nancy Tangler there.
Yeah, that's Nancy, Matt.
Of
Nancy gets that
Laffer
title.
Tangler. I mean, I think the fashion sense of everyone else just pales in comparison to Dan Ives.
It's like a bright ray of sunshine whenever
I love
he's
it
on set. It's
so
great.
much. All right, coming up, Wall Street bonuses surge to all-time highs. That's next in your Wall Street beat. This is Bloomberg. It's getting out of high interest. Look at what's making headlines around the world. This morning, The Atlantic published the signal messages that journalist Jeffrey Goldberg received from U.S. national security officials about military strikes in Yemen. Since the publication of the original story, the Trump administration and the FBI have downplayed the messages, stating that they did not contain classified information. BlackRock is integrating complex private investments into its ready-made portfolios for individual investors. The firm calls it a first for the asset management industry, and Wall Street bonuses are hitting new record highs. The average payout last year was over $240,000 per person. That, according to New York City Comptroller, and the total pool hit the largest since record-keeping began at more than $47 billion in Wall Street bonuses, Danny.
All the luxury restaurants in New York about to be flooded with bankers spending that splashy payout. Let's stick with that on today's Wall Street Beat, and Bloomberg's chief Wall Street correspondent Sri Natarajan joins us now. So Sri, I guess last year looked really good for bankers.
Yeah, don't forget about the car dealerships as well.
Yeah?
It's not just the restaurants. Look, undoubtedly, the final year of the Biden tenure, as has been the case for much of the last few years, Wall Street has had a very good run, and that is evident in the numbers. It was evident in some of the reporting earlier this year when we got concrete numbers from the biggest banks. But this, of course, is a much more comprehensive report. And when you hear that average annual bonuses have increased by 33%, you can be rest assured it was A, a very good year, and B, this was when Wall Street was not firing on all cylinders just yet. Remember, deal-making, mergers and acquisitions and IPOs are not back to where people would like to see them at. So there's still more room to run. If that also catches fire, it could be a real good payday for a lot of people across Wall Street.
This was the best payday since record-keeping began in 1987, and I'm going to go ahead and say that was a horrible year for bonuses. But profits more than doubled. So it's like they're not even taking really their fair share of the pie if you look at it like that.
Right, and again, we are talking about the bonus numbers here, but the underlying aspect of how it also helps the city and state is also extremely important. Tax revenue for the city increases by roughly $275 million is the prediction. For the state, by up to $600 million. Wall Street contributes a fifth of the tax revenue for the state. For New York State, not the city, for New York State. So it is a big contributor there. This is at a time when New York's contribution to the overall financial services industry employment pool is now down to under 20% from, say, roughly 33% in 1991. So as the economy grows, even if you don't have as many people in New York,
right,
this is still an industry that makes a lot of money, and the tangential effects are plenty.
Is it still, you know, Paul Sweeney over on Bloomberg Radio actually started out on Wall Street in 1987, and he will always say if he didn't get a good enough bonus, that's fine. He would take the elevator down, go out the door, cross the street, and get a job at the bank next door. Is this still that industry?
Looks perhaps not as easy as that, or at least not as easy as Paul makes it out to be. Paul could do that in any market. He could have done that in 1987, he could have done that in 2001 and 2008. But for most people, it's perhaps not that easy, but there are pockets of the industry where the war for talent is really intense. For those people, that is a very realistic option, absolutely.
I thought that we were seeing the likes of Citi, for example, cutting back on some of their bonus programs, some of these other banks doing that. Is that just something that's very unique to this year, and perhaps the disappointment that it didn't get off to as good of a start as we expected?
Look, in the case of Citigroup, you've picked a bank with a real serious idiosyncratic.
The biggest underperformer on the street.
They are dealing with their operational issues. The bonus cuts we're talking about are tied to a very specific issue, where special bonuses that does not affect the entire company, but a few of the senior managers. But when you look at actual underlying performance, Citigroup, much like every other bank, at least their Wall Street operations, did reasonably well enough to make sure that their bonus pool was going up last year.
Sri, great to have you on. Always great to talk about Wall Street bonuses. Sridhar Natarajan there covers Goldman and the big banks for us on the other side of the building. Still ahead, UPS is rolling out a tariff math tool for customers in hopes of minimizing sticker shock. Details on that next. This is Open Interest.
All right, let's look at some social climbers. The company's making waves this morning. First up, the mobile game company Playtika is getting a double upgrade at Bank of America. The firm is highlighting the unusually high free cash flow and says the company offers the highest profitability within the industry. Next up, let's look at Rivian, spinning out a new company that will make small EVs designed for short trips. The new so-called micro mobility company will be called also ALSO, and it will aim to launch a consumer product this fall with deliveries starting next year. Finally, let's wrap things up with UPS. They are launching a new tool. This one's interesting for online shoppers so that they can see the added cost of tariffs. The new service will calculate and guarantee the cost of any levies on products at checkout. The offering aims to address the problem of buyers being surprised with their international fees when their package arrives. Matt, I kind of don't even know how they're going to do this because tariffs seem to change every single day. That's going to be a lot for whoever maintains that website.
It'll definitely be, although you know what, you could easily set up an algorithm that just follows the actual orders that customs gets. Because when President Trump announces these things and puts them into function, he just basically sends something to Customs and Border Patrol, and they just automatically enter it into the system. So,
but like, is this gonna help customers? I feel like this would be bad for UPS. If you're about to check out and you're like, oh, my thing's more expensive because of tariffs, maybe I'm just not gonna buy it. Whereas if it was just kind of integrated, you could be like, maybe it was always this way.
Yeah, or maybe it's not as bad as you expect.
Yeah,
I recently bought something from London and I wanted to return it, and they said, listen, let us just refund you half the money and you keep the item, because they're afraid of tariffs, and there aren't even any tariffs on anything under $800.
You're gonna need to give me the name of that company so I can buy a few things.
All right, let's get a check on what's going on in the markets right now. We're basically an hour and a half into the session, and we're looking at a drop of 0.4% right now. S&P 500 trading at 57.52. The NASDAQ is down more sharply, more than 1.1%. That's because of the drop of NVIDIA. Remember, NVIDIA is worth 6% of the S&P, but it's worth 8% of the NASDAQ, so a much bigger weight on that index, still holding over 20,000 at 20,060. The 10-year yield rising 4 basis points, potentially on concern about those copper tariffs. A Bloomberg scoop that copper tariffs could come sooner than anticipated. President Trump talking about tariffs more on Newsmax, and I think investors are putting that timeline together. So you're seeing the 10-year yield slowly march back higher. We had been down at a very comfortable and chill 420 level, and now we're back up to 435. Coming up on this program, Citi is giving the thumbs up to International Paper's Investor Day. The stock has been on fire. We'll speak to Andrew Silvernail, the CEO of International Paper, next. This is Bloomberg. All right, I want to pull up one of my favorite terminal functions, and if you watch the show regularly, you'll know that that's the COMP function, C-O-M-P, go. If you do it on IP, on International Paper, and run it out a year, you can see that the company has trounced the S&P. 51% total return, the broader index only 12%. Citi also just maintained its buy rating on the stock after the investor day earlier this week. So analysts like it as well, even at these levels. Joining us here in the studio is the company's CEO, Andrew Silvernail, International Paper. You know, Andrew, I have to say, I was talking about this with producers and with Danny earlier, and a lot of the kids mentioned Dunder Mifflin, right? I also Googled paper usage, and obviously the chart, you know, goes down. But you're not making the kind of paper that we write on at school as much as you are packaging.
That's exactly right. And by the way, my kids have fun with that too. No, we're a packaging business, and obviously paper is in our name, and it's you know, we are the 10th longest standing NYSE company, which is amazing. But we're a packaging company today, and what I like about that, it's differentiated and it's all about sustainability.
So with that, I know you've took over as CEO maybe about less than a year ago, and you've come in swinging with some really big transformation plans. What is basically the biggest priority for you going forward?
Actually, I'd say there are two things. The first one is you got to be customer facing. You really have to listen to your customers. If you think about the problems that they're trying to solve in terms of getting their goods to their customers, that's what we are all about, problem solving. So getting customer facing is number one. Two, with that is how you think about where you put your resources, your people and your investment. You have to align with your customers. You got to focus on the things that matter most, and you got to move things away that don't.
You mentioned sustainability. I see that Ethisphere shows you as one of the most ethical companies. Does that still matter?
It does.
Do those things still matter?
They do matter. They do matter. If I think long term, so think a decade from now, do we think we're going to be acting in a way that's more sustainable or less sustainable? Well, we know we need to act more sustainable. Everything we do in the economy to connect to that circular economy, I think it matters. And I think ethics really matter. I was talking offset to one of the folks here at Bloomberg, and we were talking about trust and performance. And I think when you combine trust and performance at the same time, you build a great organization.
Andrew, I feel like you have a really good pulse of how corporations are feeling out there, just considering the breadth that you deal with. There has been this thought that some companies are starting to pull back, that at least some of the softer data shows concerns among consumers. Are you seeing that at all? Has there been a shift to start this year?
There has, and I think we have to be fair about that. We see that in our data, you see it in the consumer data that's coming out, but it's not something I'm worried about long term. I think for us, we make decisions in decades. If you think about building a mill or building a box plant or those relationships you have with the customer, those are decades long. We have to think that way. Yes, there's some turmoil right now. There will be some turmoil right now. We're seeing it in our numbers, but we'll push through it.
So the tariffs, you know, that were first announced on Canada and Mexico had to be a shock to you as well. And now we're looking at obviously additional tariffs on China and potentially reciprocal tariffs against Europe. How does that affect your business specifically?
Well, it does in some ways and it doesn't in others. And so we don't do very much that actually goes across borders. There's very little of ours that go across borders, but it does impact the overall economy, number one, and it does impact supply chain in terms of inflation coming up. So we're watching those two things, what's happening to the economy and what's happening to inbound inflation.
Well, on that point, because you mentioned you have to build steel mills, and these are projects that take time and money. As a CEO,
build paper mills.
Paper mills, yes, sorry, paper mills.
Lots of steel
wow, steel mills. That would be interesting. That'd be really, I know that's not included in the transformation plan. Paper mills, thank you, Andrew, and Matt. As you're building more paper mills, do you look at the current set of uncertainties and do you delay CapEx at all? How do you think about spending right now?
We are not. We are not delaying CapEx. Actually, when you asked about the biggest things we have to focus in on, those two things around focus on the customer and getting our asset allocation correct, we're actually going to be spending money. We need to and we have to because we need to be closer to our customers and we need to be world-class in terms of cost and service.
We spend so much time talking about the negative impact of the things the Trump administration has done so far, and I joke about sustainability and ethics, but he also also wants, the president wants to reduce regulations. He wants to reduce taxes, especially for companies that make stuff in America, which IP does. And I suppose tariffs on foreign products coming in can only help you since you're building stuff here. So do you see some positive fallout from Trump 2.0?
Well, I think as we focus on the long term, I think that's really the case. We got to focus on 10 and 20 years. Tariffs have a place in the world economy. I think a free trade economy is a good economy over time. And I think getting the playing field correct, getting the playing field right, we'll thrive in that. We'll make investments around winning in our local markets, winning for our customers, helping them get their goods to where it needs to be, and IP will succeed in that environment.
How much of this are you able to incorporate into your outlook at this moment? Is it when you give numbers to the financial community, are you including these differences in the macro environment, or do you kind of hold off until we get more clarity?
You know, it's a little bit challenging. Yesterday, we told our investors we thought we'd be somewhere between $3.5 and $4 billion of EBITDA. I think the downside to that, so if they pick a midpoint, the downside is probably weakness in the economy in the short term, and the upside is, I think, relief in there. So in the short term, it matters. In the long term, I don't think it does.
I have a Tom Keene question here.
Oh, please do.
Chair Greenspan apparently tracked corrugated box production as an indicator of the health of the economy. How's it look? How's the economy look from that perspective to you?
I tell you, outside of kind of the little bit of craziness in the last 4 to 8 weeks, it's been pretty healthy, both in really in the U.S. Europe's been a little bit weaker. Our expectation is that over time that will take care of itself, and the underlying business. Actually, Greenspan was right. We actually track the economy really well in both markets, and we pay attention to that too.
Very cool. Great to have you here on set with us, Andrew. You'll have to come back. Andrew Silvernail, they're the CEO of International Paper. Let's take a look at what the markets are doing. An hour and 6 minutes into the trade, we see red arrows across the board, and the NASDAQ getting hurt a little bit more than the S&P, but coming well off session lows. The NASDAQ down now almost 1%. The S&P 500 down 0.3%. It's not being helped by most of the Mag 7 companies. In fact, Apple is the only one of the Magnificent 7 companies that's trading in the green, and only just. The 10-year yield, you can see, continues to rise. Investors sell that debt, 434.61, going out 5 significant digits for Tom Keene.
I almost thought you were wearing a bow tie with all of that. Anyway, let's take a look at some of the stocks that are moving underneath the surface this hour with Bloomberg's Alex Semenova. Alex, kicking things off with Boeing this morning. What you got?
Hey, Danny. Boeing has been ordered by a federal judge in Texas to stand trial on June 23rd. This is in the criminal case related to the deadly crashes of its 737 MAX jets back in 2018 and 2019. The company has previously sought leniency with the U.S. Justice Department, but a plea deal was actually rejected back in December. So this is a significant development here in determining whether Boeing is culpable for these crashes that killed, of course, 346 people. Shares are down just a tad this morning, but they're actually up 3% on the year, outperforming the broader market. I'm also taking a look at Dollar Tree. That company is offloading its family dollar chain for about $1 billion to Brigade Capital Management and McCallum Capital Management. The deal is set to close next quarter. This comes a decade after buying the business, actually for $9 billion. So selling it at a significant discount here. And this is actually a disappointment in its effort to establish itself as a dollar store giant, given the fact that about half of its stores will close after this deal. Though this is being offset by some pretty solid earnings. Shares are up more than 4% today, but down 7% on the year through yesterday's close. And then last but not least, of course, taking a look at Tesla, which is sliding today after 5 consecutive days of gains. It's obviously been a brutal stretch for the electric vehicle maker as investors worry about growth prospects, and also that Elon Musk is distracted by his White House duties. The stock is down about 30% this year, and actually next week is going to be a significant catalyst for the company, given it's set to report deliveries around April 2nd, right on tariff days, actually. So it's going to be an eventful week.
Liberation Day. Alex, thanks very much. Bloomberg's Alex Semenova there talking to us about some of the movers. Coming up, Wall Street bellwether Jefferies reports results after the bell today. We'll have a preview next. This is Open Interest.
Jefferies, a Wall Street bellwether for investment banking activity, reports results after the bell today. Neil Sipes, financials analyst for Bloomberg Intelligence, joins us for a preview. And Neil, we are at this point at a very different place than we thought we would be to start the year when it comes to bank and banking activity. What's the expectations for Jefferies?
Yeah, and I think you highlighted it well, that we're at a very different place that maybe we started the year at. The expectations for 2025 were a pretty sizable capital markets rebound, really led by M&A after a handful of years that were pretty slow, especially after a record 2021. Where we are today, obviously, we've had a serious introduction of volatility into the market. The first couple of months, January and February, we saw deal activity down 20%. March has been a little bit better, surprisingly, just given the introduction of volatility. So what we're going to be looking at with Jefferies today is how have those trends played out in the first handful of months this year, and what's the ultimate outlook for 25 and beyond with this sort of new regime of potentially higher volatility and everything that we've seen.
In terms of the M&A market, how has the advisory business at Jefferies performed, maybe specific to that country, and what's then the broader outlook for 2025? I mean, it's been a slow start, we know. We were talking with Crystal C about, deals thus far. Danny pointed out it's been kind of a drip feed, but what's the outlook for the whole year?
Yeah, and I think that's right. And Jefferies is a bit unique in this scenario when you stack them against some of the largest players. Jefferies, the story behind them has been significant hiring at the senior level, managing directors. So when you look back at 21, I mentioned that was a record year. Their headcount's up almost 50% from that level. So you simply underwrite a sort of normalized M&A environment. The revenue run rate, the earnings potential for this company is significantly higher than it was in the past, but nonetheless, you still have to have a generally normalized M&A market, which we haven't necessarily seen since. So with that being said, they have significant market share potential relative to some of those larger players, and that's been a story for Jefferies for a long time.
Matt and I were talking earlier in the show about how the New York Comptroller was reporting record bonuses for the banking industry last year.
Over $47 billion, the Wall Street bonus pool.
It's a really remarkable amount, even considering just how much better they did during COVID, for example, at this period. And if we're going to something that looks like normalization, does that mean that the payout for talent, the remuneration, the war for talent, and the ease of getting new jobs will also be normalizing?
Yeah, I think that it is tough to say, 2.5, 3 months into the year, what the whole year is going to look like. We know seasonally the second half is stronger as well, so everyone's going to be holding their breath for a potentially better second half than first half, but ultimately, yeah, you're going to have to be watching how the deal activity trends throughout the year. Obviously, compensation is the largest piece of expenses for all investment banks. Ultimately, that is going to reflect the revenue environment, so there is some protection to profit there. When you have revenue drawdowns, you can sort of obviously pay out less in bonuses, as you noted. When revenue increases, you're obviously going to be going the other direction, but ultimately there is operating leverage in that business, and that's why when we see periods of rising revenue, which was the expectation for 2025, there were some pretty sizable margin expansions underwritten in these investment banks.
If I look at the KBW index, BKX index on the Bloomberg, it's a bank index, modified cap-weighted index, 24 exchange-listed Wall Street companies. It's had a great run lately, but it's only sort of catching up to where it was at the beginning of the year. What's the outlook in general for the industry that you cover?
Yeah, and so I guess, capital markets may be a fairly small component of some of those banks to that index. What we're looking at here is a very capital markets oriented. Jefferies is not necessarily a bank. It's not taking deposits. It's not making loans. So everything that they're earning is generally from the fees on advisory, from underwriting to M&A, to equities and fixed income trading. So ultimately, it's going to be heavily capital markets oriented. How are institutional clients, strategics, corporates, private equity sponsors, how are they transacting? How are they viewing at 25 and 26 from now? And how is that going to influence their activity moving forward?
Neil, great to have you in here.
Yeah.
We both appreciate it.
We both certainly do, and it'd be interesting to see what Jefferies comes out with. Neil Sipes of Bloomberg Intelligence. Coming up, copper tariffs may come sooner than expected. We're going to get the latest out of Washington, D.C. next on Open Interest.
The Atlantic has released the transcript of a group chat between top U.S. officials on Signal that inadvertently included its top editor. Joining us now is co-host of Balance of Power, Kailey Leinz. And Kailey, this is a story that I imagine everyone in Washington is focused on. But I think the broader question is, will there be any fallout, or is this just going to be a typical sort of, Trump story that goes out of the news cycle in 24 hours?
Well, a lot of that depends on the decision-making of the president himself, to who this point, Matt, at this point, is still, as of this morning, even after the publication of this full Signal group text chain, has said he's standing by his team, that it was, yes, a mistake that this journalist was inadvertently added, but because the attack against the Houthis went off perfectly in his mind, that no harm was actually done here. That said, what we were hearing from the administration yesterday about the notion that no plans were actually shared, that there was no classified information on this group chat, is what the releases today put into question. The Atlantic had decided not to release all of this material on Monday due to national security concerns, but has now done so, detailing in full what the Defense Secretary Pete Hegseth posted at 11:44 a.m., which included specific times, specific military aircraft like F-18s or Reaper drones that were to be used to strike at different time periods, even mentioning a terrorist target at his known location. Now, what we're hearing from the administration is that this does not constitute quote-unquote war plans, as the Atlantic initially characterized, though a specific attack was mentioned. And we're seeing, once again, officials who were on this group chain, the Director of National Intelligence, Tulsi Gabbard, and the CIA Director, John Ratcliffe, facing a second day of questions from members of the House Intelligence Committee after testimony in the Senate yesterday. That, no surprise, is getting pretty dicey, as the ranking member on the Intelligence Committee, Jim Himes, is suggesting that it's only an act of God that kept American pilots from dying as a result of this breach.
So, Kailey, if Trump is sticking by his team, are there any real consequences? Are there any mechanisms to have there be things like Pete Hegseth, for example, be forced to step down? Is there any other thing, be it the Senate, be it some of these lawsuits that are popping up, that could have that type of consequence, or does it all come down to Donald Trump?
A lot of it comes down to the decision-making of the president and whether he would request or accept a resignation letter from any of the individuals involved, be it Pete Hegseth or Mike Waltz, who, of course, claimed accountability and taken personal responsibility for starting this chain in the first place. We could see congressional investigations into this. Obviously, there's the testimony happening today, but we've also heard from the Armed Services Chairman in the Senate, Roger Wicker, a Republican, who has suggested he would like an inquiry. But it's unclear where that would actually lead, keeping in mind that there are Republican majorities in both the House and Senate who, by and large, stay in lockstep with President Trump. And if President Trump is signaling he does not want his people to go, it is seen as highly unlikely that anyone would cross him on that. I will say, you mentioned lawsuits, Danny. We did see a liberal group, American Oversight, filing a lawsuit against some of these officials yesterday over essentially the records acts that bind officials, because some of these messages in Signal were set to automatically delete, which they argue is in defiance of laws that require officials to keep records of their communication. So we could see some of this playing out in court, but by and large, the administration is really just hoping that this story eventually leaves the news cycle and they can move on to other things without any heads actually rolling.
Well, that's leaving the news cycle does really seem unlikely, considering the scope of what's been released. I mean, you can tie this to stories like Bradley Manning or Scooter Libby, right? Have any American lives been put at risk here? Have we seen any, CIA outings like Valerie Plame? Have you seen anything like that in this Atlantic release?
No, and I would point out, Matt, that the Atlantic still chose not to release the name of the CIA operative that the director, John Ratcliffe, had named as the person who would be his touch point for these conversations after a request from the CIA not to do so. That said, and what we are hearing from the administration is that there was no harm done here, that all of these attacks went successfully, they were not thwarted, and everybody got out safely. But what I've been hearing from people close to the intelligence community, others here in Washington who have worked in prior administrations and are familiar with security protocol, is about the future national security risks that it could pose, given that Signal is not a completely fully 100% secure platform. It is still vulnerable to hacks from American adversaries like Russia or China, also keeping in mind that this may call into question allies who intelligence share with the U.S., the so-called Five Eyes Alliance, for example, thinking of countries like the UK and Canada and Australia. Their fear is that it may cause other countries who provide the U.S. with valuable information to second-guess doing so because of concern over whether or not the channels are secure and whether that information will actually be contained. So what we're hearing from people who are upset by this episode is more about the longer-term risks, what it could jeopardize in the future, than necessarily what happened with this particular episode.
Balance of Power, as everyone knows, is my favorite program. Kayleigh, kicks off on Bloomberg Television at 1 o'clock. You're also on again, I believe, at 5 o'clock. What have you guys got planned for today?
Well, we're going to have to talk about tariffs as well, as the administration is now at least considering, according to Bloomberg reporting, front-running copper tariffs, perhaps in the next couple of weeks rather than a couple months, which obviously for anyone looking to get their hands on physical copper in the immediate term and import it before those kick in could throw a little bit of a dent into those plans. We also have to talk about the Congressional Budget Office, which released today its estimate for the X date when the U.S. is at risk of defaulting on its debt. They say that could be as soon as August, though a lot of that is going to depend on ultimate tax receipts. They warned of the risk that you could see something in May or June if the money coming into the Treasury's coffers is lower than they currently estimate. All of that figuring into the tax debate that is still ongoing on Capitol Hill, guys.
All right. Kayleigh, thanks so much for joining us. Balance of Power co-host Kayleigh Lines there. Coming up later today, we've got an exclusive interview with Democratic Senator Elizabeth Warren of Massachusetts. She's more than likely going to have something to say about this as well. Let's get a quick check on markets here. An hour and a half into the trade, we are looking at red arrows across the board, but well off session lows. The S&P 500 now down only 0.3%. Coming up tomorrow on Open Interest, Morgan Stanley's Mike Wilson joins us. We've also got Bob Sloan of S3 Partners and the founder of Porsche backdater Singer. I think they'll argue that it's much more than that. Rob Dickinson joins us, formerly of Catherine Wheel, and the CEO, Raj Nair, formerly of the Ford Motor Company. I'm very excited about that. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde, and this is Bloomberg Technology. Coming up, the Magnificent Seven is in the red. A sell-off in tech megacaps as Trump's trade war is still on the horizon. Plus, an exclusive conversation with the CEOs of Anthropic and Databricks, who are out with a new partnership to bring Claude models to the enterprise. And advertisers return to X, with the platform projected to post a jump in advertising sales. That's according to new research. We'll bring you those exclusive numbers later this hour. But first, we check in on a market that is sinking once again. The Nasdaq 100 off by 0.9%. But we're seeing the Magnificent Seven all trading lower and by some significant numbers. Move on and have a look at what's underneath the hood as we still try to digest what happens in terms of tariffs and ultimately what valuations should be at for big tech. We're off by 3.6% again for Tesla. This is as we see the downward trajectory continue after the European numbers bode ill for the company. We're looking at fundamentals that continue to get under pressure. And indeed, Nvidia's off by 4%. We're seeing all the points drags from Mag 7. I shine a light on what's happening with ARM. We'll get to that in a moment. But the legal tit for tat still going on with Qualcomm and ARM. And I'm looking at Amazon off by 1.4%. Maybe the one that's starting to look like it's more juicy from a valuation perspective. Let's get to it with Ryan Velestelica, who is with us. And this is another day of stress on the valuations of the Magnificent Seven. Let's just go to Nvidia and some of the reasons that we're seeing the sell-off. From a macro perspective, is this about the economy?
Yes, broadly speaking, yes, I would say that is the case. There is still a lot of uncertainty about tariff policy, about the implications for overall economic growth, the outlook for the consumer, the outlook for businesses. We are seeing signs that businesses are maybe pulling back on investments just because they are not sure what the tariff situation is going to be, what the economic outlook is going to be. All that kind of frozen activity, all that uncertainty is really just causing people to take some profits if they still have them and just, kind of take a pause and step back.
But when you step back, you start to look at the valuations, you look at the fundamentals, and you've done exactly that. For example, Amazon not been trading at these sorts of price to future earnings levels in years.
Yeah, so some of these names, at the start of the year, there were a lot of concerns about valuations. Those concerns are a lot smaller now, just given how much some of these names have come down. So in the case of Amazon, they have pretty strong earnings growth. They've been really focusing on efficiency and cost cutting, things that are really improving their profitability. That is really driving the multiple down. The multiple is about half of what it was over the longer term. It is cheaper than Apple now, and just a few years ago, Apple was several times cheaper than Amazon. So that is quite the flip in narrative when it comes to tech valuations. Amazon is cheaper than other retail names like Walmart and Costco. It's a stock that, given people continue to have pretty optimistic views about its long-term growth potential, the multiple here, it wouldn't surprise me if you start seeing people look at a name like this, say, it's really come off its lows. The fundamentals look pretty intact. Still a lot of, earnings growth potential and revenue growth potential ahead, even in a rockier economic climate. Maybe that's why they start taking a look at a stock like this.
But who is taking a look at a stock like this, Ryan? You get so much inbound in response to your stories. Are people starting to want to catch what seems like a falling knife?
That's something I've heard, the falling knife thing. I do think people still feel like these are pretty safe companies. The story isn't broken. Even if some of the air gets let out, even if the multiples come down a little bit more, I don't think people are really concerned about the long-term prospects of these companies. They're still considered to be, very dominant in their field. Even if we see a weaker economic outlook, it wouldn't surprise me if we saw Amazon, for example, maybe consolidate its market share, especially in online retail or retail overall. Cloud business remains very strong. It has an ad business that's growing a lot. There's certainly a lot of positives you can point to here, even if we see a lot more volatility in the short term.
Ryan Velestelica, we thank you. From a macro perspective across Magnificent Seven. Meanwhile, just take a look at ARM and Qualcomm once again. Now, this is as ARM is trading significantly lower today, as you can see. Qualcomm, as is being reported, has begun a global antitrust campaign against the the chip designer, alleging in private meetings that ARM is guilty of anti-competitive behavior. It's all according to sources, and we want to get the analysis of all of this with Mandeep Singh from Bloomberg Intelligence. And for me, it immediately becomes a question of just what a distraction this is. But ultimately, this is Qualcomm coming out and feeling and stating that ARM is getting competitive with them and therefore stopping access to their technology, to their designs.
Yeah, and especially when it comes from one of your top two customers. In the case of ARM, Qualcomm is a top two customer. It's never easy. So look, ARM did bring a lawsuit back in 2024, which they ended up losing against Qualcomm. And to me, it reminds me, what Qualcomm faced against Apple. I mean, I remember 2017 to 2019, they had the back and forth where Apple was using Qualcomm technology and Qualcomm didn't go, anywhere with sort of getting more royalties from Apple. So I think ARM is in a weak position here, given, Qualcomm is using all the IP that ARM has to offer and paying for it. And, granted, they made that acquisition of Nuvia, but at the end of the day, they're still using ARM's instruction sets, and it's hard to really prove that, Qualcomm is doing anything wrong. So I'm not surprised that they are going all in with this antitrust campaign, but I think ARM is in a weaker position.
Qualcomm making complaints to the European Commission, we understand, the FTC in the US, Korea Fair Trade Commission, Mandeep. I just want to get the perspective of the companies. Qualcomm has declined to comment. Spokespeople from this regulator is also declining. ARM saying it's confident it will prevail. But I go to the distraction perspective here, because they say they remain focused on enhancing innovation. Does innovation generally dip when companies are locked in what might be a years-long legal disputes?
Yeah, and especially, with the AI market moving so fast with inferencing, everyone is trying to come up with new designs in terms of how to do inferencing faster. So you're right, it is a distraction. And in the case of Qualcomm, they have expressed interest in even Intel. Granted, Intel has a new CEO now, and we don't know what they will end up doing with the overall business. But clearly, Qualcomm has ambitions on the CPU side, and really, they want to do much more with the inferencing chip beyond smartphones. So to your point about distraction, all the back and forth and the lawsuits do seem like a distraction.
Many people wanting to go beyond the smartphone in this environment. Mandeep Singh, thanks for joining us. Coming up, we'll hear from the CEOs of Anthropic and Databricks on their brand new partnership, AI policies under the Trump administration, and so much more. This is Bloomberg Technology. Databricks and Anthropic just announced a 5-year partnership to offer Anthropic models and services on Databricks. Basically, it's bringing Anthropic's Claude models directly to 10,000 companies. Tim Stenovic sat down with the Anthropic CEO, Dario Amodei, and Databricks CEO, Ali Ghodsi, to discuss what this means for their customers.
What it really means is that you can use securely Anthropic inside Databricks. You can get all that intelligence, especially all the programmability. These models, Claude, are really good at programming, and you can use that for data science, and you can use it together with all the data that we have. So enterprises have been storing their data with Databricks for the last decade. How do you build AI that can reason on that data? So we're super excited to bring the LLMs and that data together in the partnership.
Dario, we know what Ali's getting out of it. What are you getting out of it?
So we're really excited to bring Claude to a wide range of enterprise customers. Claude models are growing very fast. Models are the API revenue is growing at something like a 20x annualized rate. But we want to make sure that our models can meet all the requirements that complex enterprise customers have. And we can do this with the help of Databricks. As Ali was saying, we can take our models, which are the world best for coding and many other tasks, and use Databricks tools to operate on the customer data. And we can work together to secure that customer data and make sure that customers can be assured that they get the proper security experience. Both companies value things like safety, security, privacy, things that enterprise customers greatly value.
Where is the fastest area of growth for you?
I think by far and away the fastest area of growth is code. Claude models are better than anything out there by a wide margin in terms of how they code. We power a large number of players in the space, including Cursor, Codium, Cognition, GitHub Copilot, Vercel, SourceGraph, many others that I'm not even mentioning, and we're starting to build an ecosystem around this area. Now, all that said, we also have partners in many other areas. We have partners in the financial space. We have partners in the biomedical and scientific research space. We work with companies in the legal and productivity space. So it's pretty broadly spread. But among those areas, I think code has by far been growing the fastest. I'm
curious about each of your views on the administration and what we've seen thus far out of Washington. David Sachs, he's crypto and AI czar. Ali, what does he mean for your business?
I think it's great that we have people that actually understand the tech that are in the government. I think it's early days, so we're working together to figure out what's the best way to bring value to our customers.
How are you working together? Are you in touch with him?
Yeah, I mean, we've given our feedback on AI policy and other things, and they're requested that. I mean, I think the government's requesting it broadly from the industry, so we're excited.
Dario, what about you? Are you in touch with the administration?
Yeah, we're in touch with this administration just like we've been in touch with the last administration as well. The thing I like to say is, AI has big implications for society, so it's very important for Anthropic to be about the policy and not about the politics. So we don't care which, regardless of which administration is in office at the present time, we have a set of things that we think it's good to do, in AI policy, and we've told the same thing to the Trump administration that we've told to the Biden administration. We have folks that we've talked to in this administration, just like the last administration, and we've delivered exactly the same message both times. We aim to be consistent. We aim to be nonpartisan and offer our view of how to make the industry go best.
What is the U.S. government's role? Well, what should the U.S. government's role be in your view? Yeah,
so we laid this out in our RFI submitted to the OSTP. I think that was a couple weeks ago. But things that we've emphasized include, I won't get the complete list here, but include export controls on chips to China, testing of models for national security risks such as bio or cyber risks. The government should have a role in provisioning as much energy as possible. The government should help to secure AI labs. We're very concerned about security. We talked a lot about security, as part of this partnership. But another kind of security is, we're worried about our models and our technology being stolen. So those are a few of the areas where I think the government can have a constructive role.
Anthropic CEO Dario Amodei and Databricks CEO Ali Ghodsi, along with our very own Tim Stenovec. And look, let's stick with global competition around AI models. It is top of mind for US tech companies because, well, ever since DeepSeek launched, the Chinese tech industry has been flooding the world with more AI models. Bloomberg's Peter Elstrom joins us for more. And Peter, it feels like every day there is yet a new update or a new release coming from DeepSeek and so many others. Is that the cadence we're getting?
Yeah, I think you're pretty much exactly right. It has been almost every day that we've been seeing these new AI services and models that have been introduced from Chinese companies. We count at least 10 of them over the past 2 weeks, and those are really just the major companies. This is Baidu and Alibaba and Tencent. Ant Group also came out with some AI breakthroughs. And really what they're doing is they're putting a lot of pressure on the profit models that we're seeing in Silicon Valley, where they're providing open source AI services that people can use and modify and incorporate into their technology to be able to use all of the know-how of the AI models without paying some of the prices that you would have to pay if you went to more premium models like OpenAI, like Google in particular. So they're putting some downward pressure on those companies in particular. They've been mostly focused on the China market so far, but they certainly have global ambitions, and we'll see how far they take that.
Ultimately, it feels as though this is a rerun of what we've seen in plenty of industries. You think of China and EVs, you think China of solar. They've driven down the costs and the prices. But what does this mean? What's the implication for a US competitor? Is it a bad thing? Got to be good for customers.
Yeah, those are very interesting parallels. If you look at EVs or you look at solar panels, certainly there are some negative implications for other countries around the world. It's not exactly clear how this is going to play out, though. At this point, they are driving down profits in certain areas of the AI industry, but they're probably shifting the competition to other areas like execution. Who can actually build the services to connect some of that AI know-how with corporate needs, for example, or consumer needs? And you're going to see a lot of innovation, certainly out of Silicon Valley and the companies that we were just talking about, and also out of China. Overall, it's probably good for the AI market. You get rapid commercialization of these services, you get lower prices, you get some robust competition, and that will probably lead to more innovation down the line.
And certainly, Apple CEO Tim Cook been going to that home of innovation of late at Hangzhou. Bloomberg's Peter Elstrom, we thank you so much. All things China. Meanwhile, coming up, advertisers reacting to Musk's power in Washington by returning to X. We'll talk about the revenue growth that the platform is expected to see. That's next. Meanwhile, check in on Microsoft shares. We're only off by 0.25%, not as much as the rest of the tech ecosystem. However, TD Cowen analysts are saying that the company has walked away from new data center projects in the US and Europe. Analysts attributing the pullback from an oversupply of clusters of computers that power AI. Remember, they sent shockwaves, TD analysts did, around Microsoft pulling back from data centers back in February as well. This is Bloomberg Technology. Time now for Talking Tech. First up, Google's Gemini gets an upgrade. The company's released version 2.5 of its AI model that it says is capable of reasoning before responding and resulting in better performance and accuracy. Now, the latest model is available to use in Google's AI Studio and Gemini app. Plus, OpenAI is now making it simpler to edit images in ChatGPT. During a live stream on Tuesday, the company showed how users could now refine images in ChatGPT with a series of conversations. Now, according to OpenAI, the program will now also be able to better create diagrams, infographics, and logos for professional use. Meanwhile, Elon Musk's Grok is making political waves in India. The AI chatbot that Musk described as maximally truth-seeking has made some controversial responses around Indian politics, including criticizing Prime Minister Narendra Modi and praising opposition leader Rahul Gandhi. Grok's replies has said to have sparked a political firestorm within the Indian government as they take a look at making action against users who prompt for those responses. And look, let's just stick with Elon Musk, because for the first time since the billionaire acquired X, where Grok is, the social media platform is on pace to see advertising revenue grow. That's according to research firm eMarketer. Jasmine Emberg's with us, Vice President and Principal Analyst for eMarketer, and you brought us this research exclusively. Jasmine, where did the data come from? How are you tracking this increase?
So the data is from our proprietary forecast here at eMarketer, and we have a multi-source methodology where we have a team of forecasters that regularly goes through a variety of different sources, from third-party research firms to interviews with advertisers, and looks at broader macroeconomic and digital advertising trends to put together these forecasts.
The drivers of growth, therefore, those advertisers that are returning, are they coming back with a feeling of joy and desire to spend, or is there something else going on here?
Look, first I would say that this is a recovery, not a rebound. Even with the growth that we are projecting, X's ad business in 2025 is still going to be smaller than Twitter's ad business was back in 2019. And to your question, some of this growth is actually being driven by fear. There are plenty of advertisers out there now who see spending on X as kind of a cost of doing business in order to mitigate any potential legal or financial repercussions. The problem, of course, is that fear is not a sustainable motivator. Luckily for X, it's not just fear that's driving this growth. It has also been able to secure a new base of advertisers, including small and medium-sized businesses, which is something that Twitter historically struggled with. The problem there is that these advertisers have less money to spend, and so while they're helping to prop up the growth, we're still not seeing spending levels reach the same heights as they were prior to Musk's takeover.
Okay, so take us back to, you put the $2.25 billion basically expected for 2025. What is that versus pre-$40 billion acquisition by Elon, and where does it go from there?
So it's smaller than it was in 2019. And of course, Twitter saw very strong growth like other social ad businesses during the pandemic, which means that pretty much all of that growth that it gained is lost. We're still expecting the ad business to continue growing in 2026 and 2027, which is the end of our forecast. But of course, we have less visibility into those years because the situation is still incredibly volatile. There's still a lot of concerns about brand safety among advertisers. And as those attitudes continue to evolve, we could see shifts in spending. Of course, there's also the economic uncertainty that's impacting advertising budgets, as well as the uncertainty at TikTok. So there's a lot of different moving parts that could change how advertisers spend their budgets.
When you talk of the advertisers who are coming back, whether it's through fear or a desire to access new products, have the main ones that took on Elon come back? Has Disney come back, for example?
We don't have an exact list of all of the advertisers that have returned. What we do know is that many of the big tech advertisers have returned. There was also reports that Apple, for example, which was once a target of Musk's, has returned. But there's plenty of evidence to show that many of these companies are returning to spend, though again, not at the same levels as previously.
I like how you brought in TikTok there as well. We're all waiting as to what April the 5th really brings, but would X benefit from TikTok being taken off the scene? It feels like it's always a Meta driver rather than an X driver.
So the biggest beneficiaries of TikTok disappearing would be Meta and YouTube because of Instagram Reels and YouTube Shorts. They're obviously the most natural fits for users, for creators, and for advertisers. In January, we actually released an analysis that showed that about 50% of reallocated TikTok ad dollars in the US would go to Meta and YouTube. There would be, other spending to other platforms, potentially also X, but mostly to other social platforms like Snapchat, perhaps even Pinterest. We saw some of that during TikTok's brief shutdown, as well as other players, competitors to TikTok in other industries, thinking about retail media like Amazon or even streaming services, because TikTok touches so many aspects of our digital lives.
Very briefly, we've only got about 30 seconds. The competitors to X, are they thriving or not?
Well, what's been really interesting to see is there's been a resurgence now as well in growth in some of these competitors. We saw after the election, of course, that Threads and Blue Sky saw many new users coming onto the platform, and that seems to be sticking. But even as X has lost users, both of those platforms remain significantly smaller.
Jasmine Enberg, great to have you back. eMarketer, we appreciate it. Now coming up, Kristen Smith, the Blockchain Association, joins us to talk about crypto legislation moving through GC. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. A quick check on these markets because of after a few days of stability, we're coming back off. Maybe we're selling some of the moves that we've seen in the last couple of days. Maybe we're taking a few profits after Monday's stellar charge higher of more than 2% on this particular benchmark, and we sustained growth yesterday, but we're now off by a percentage point, and really it's the Magnificent Seven that tug us lower. We're off by 1.8%, let's call it, on this particular index, and really it's the likes of Nvidia, which are off by a significant amount. So too is Tesla. Take a look at what that particular name is doing. We know it's volatile. We know that the bulls, like Kathy Wood, remain in this name, but we're currently off by almost 4%. Had a dramatically good day on Monday, pushing up more than 9-10%. However, we did then get the BYD strength. We also got the worries about European sales, and we see some of that come off on Tesla. Rivian off by 0.3%. There's some interesting news there of a spin-off when it comes to smaller mobility forms of transport. Let's get to that work with Bloomberg's David Welch. And I just want to go to the news on Rivian in particular. We understand that they're spinning off what's going to be called also, they're investing up to $100 million coming from another player, Evolve, as well. This is about small mobility. Where is there a gap in the market for that, David?
You know, there's a market for smaller urban type vehicles that, you know, don't need to go as far on a charge as the bigger vehicles Rivian sells. I think one of the issues Rivian has is right now they're selling expensive pickup trucks and SUVs that happen to be electric, and people like them. They're sort of a unique style compared to what Tesla has and compared to what Ford and General Motors sell for electric pickup trucks, but they're still very pricey for what they are at the end of the day, and it's tough for them to get scale and really drive their costs down just selling those vehicles. And they've got other models coming that would have more mass appeal, but I think with something like this, you know, the industrial logic behind it would be you're selling more vehicles and getting your battery costs down, which ultimately is how any of these EV companies are going to get into profitability. They've got to get those costs down, and you can't do it selling 50,000 trucks and SUVs a year.
They call it micro-mobility company for also, and I correct myself that it's Rivian and a VC firm, Eclipse, who are going to be helping finance all of this. I mean, this comes at a time where the competition does seem pretty fierce. Even though that Chinese competition can't make its way into the United States, globally, all eyes on EV, all eyes on more efficient and cheaper models, David. Compare what's happening with Tesla at the moment. Just why the pressure continuing on the stock?
Yeah, Tesla's, it's really an interesting case here. I get asked this all the time. Is that the political pressure because of Elon's stance and his closeness to Donald Trump? And I think that's probably true on the margin. Maybe more than that. There's really not data that tells us how much of that is true. But look, EV sales were flattening out even before Elon became essentially part of the Trump administration. So they were already losing growth rates as a company. And a lot of that is competition from China. BYD, Li Auto, those players over there, they have very good products. They're coming on strong. It's tougher for foreign companies operating in China to get the sales they want. That includes Tesla. I think there is political pressure in Europe that's causing Tesla to lose some sales. And don't forget, they're changing over the Model Y, which means they've got production down. That always cuts sales for any car company. I think that's also a big piece of it. And then the thing you just mentioned, competition. You know, in Europe, you've got all the European automakers adding more EVs and coming on pretty strong. In the U.S., you've got Hyundai, Kia selling a lot of new product. General Motors is bringing out a lot of new EVs, and they're ramping up production right now. So there's competition here that wasn't here 2 or 3 years ago that Tesla has to deal with. And by the way, you know, the Model Y is being changed over, but this is a product line that's pretty stale, with the exception of Cybertruck, and Cybertruck is too quirky to sell in really big numbers.
Certainly is. David Welch, thanks so much for joining us. Meanwhile, let's just go to another key stock you could keep an eye on. GameStop is having a stellar day. It's up the most since June of last year. That's as Bitcoin is interestingly off by 1.25%, 86,000. But these two stories are linked. GameStop is up more than 15% because they announced after their earnings yesterday that they are indeed going to move forward with having Bitcoin on their own balance sheet. Yet another company that's doing it, all following Michael Saylor, of course, with Strategy, but many others have done it. Block, for example, think of the way in which they store crypto on their balance sheet. Bitcoin currently off by 1.25%, so GameStop are not enough to drive it higher. But this comes in the context of a major crypto summit that's underway in DC at the moment, and legislation regarding digital assets is, of course, making its way through Congress. Joining us now is Blockchain Association CEO Kristen Smith. I just want to start on the idea of more companies storing Bitcoin or other crypto on the balance sheet. Is that because the moon music is changing? Is that because regulation is finally creeping through?
Yeah, and I think we've had such progress in Washington, Caroline, that I think it's pretty clear across institutions, across traditional companies, across those who are managing treasuries of large organizations, that digital assets are something they should be thinking about. I was up in New York last week at the Digital Assets Summit, and the amount of enthusiasm and excitement amongst the TradFi and institutional investors was really great, and I think that's extending to companies as well. So I think it's smart. I think it's something a lot of companies are looking at, and I think we're going to see more announcements like this going forward.
It's smart because GameStop gets a pop in its stock when actually its revenues are down 28% year on year. They're able to sort of harness what feels like a feel-good effect that retail likes to trade off. So tell us actually fundamentally how this sort of helps businesses and how you see regulation in particular supporting crypto right now.
Yeah, well, I think the regulatory clarity is key. This is something that the industry has been talking about for many years now. We're seeing a lot of progress. We've seen a lot of actions taken to undo the damaging policies that were put in place when Gary Gensler was the head of the SEC. And we're seeing Congress do a lot of work to establish and put the legislation in place that we need. It seems like every week here in Washington, we have another vote on crypto. 2 weeks ago, we had the Senate Banking Committee, which very rarely holds markups, had a vote on stablecoin legislation. We're expecting a House committee to do the same on their counterpart legislation next week. We also have the final vote to undo the tax policy that President Biden put out at the very, very last days of his term, is going to be repealed by Congress this week. So we're seeing steps. There's a lot of momentum. There's still a lot of work to do, but I think, we've got the White House, we've got the leaders in the House and the Senate are all communicating, they're all talking together, and they all want to get this done. And I think it's a cornerstone of sort of the administration and Congress's priorities for making the U.S. more competitive, more innovative, and more modern. And so I think that does, going back to your original question, give companies some comfort that they can look at these assets as something that will be more stable, that will be welcome, and something that they need to be thinking about going forward.
What's not being tackled that you'd like to see tackled from a regulatory perspective, Kristen?
It's interesting. They're really covering the list. I think it's two steps, like I was saying. The first step is undoing the policies of the past. We've seen the SEC dismiss litigation across the board in the industry. We're seeing Congress fix this IRS rule that was enacted late in the administration. And we're seeing agencies like the OCC undo some of the letters and interpretive guidance that they had put in place over the past 4 years that made it very difficult for crypto to integrate with the banking world. And then, in terms of what we need to get done, we need a stable coin